Well, just to put some statistics to it, these top names that we're talking about is responsible for about 95% of the returns this year, right? And the S&P is up, depending on when you watch this, in the teens, right? 13 to 15% this year. So they're contributing to a massive share. When you look at an index without those biggest names, you're probably up maybe 2 to 5% this year.
Okay.
And so that's the delta.
Hello, Apriem family, and welcome to episode 10 of Apriem Financial Cents. In this episode, I sit with Benjamin Lau, the Chief Investment Officer here at Apriem Advisors, and he gives us the current market update.
What's going on right now? I mean, I guess bring us up to date. You want to summarize kind of where we're at?
Well, so we're entering the fourth quarter of 2022. I'm sorry, we're entering the fourth quarter of 2023.
And
it's been kind of
22 yet.
But it has been a kind of a crazy year, right? Especially after the craziness we saw last year with really the start of the Fed interest rate hiking cycle last year, and that had some huge collateral damage for the markets, for the stock market and for the bond market last year. Now we're entering the fourth quarter of 2023. The Fed has continued that path, but they slowed down recently. But luckily, the stock market, the equity markets have taken it a lot better, right? And they've really recaptured a lot of the loss that we saw last year. But what does that mean, right? And so just because the stock market has really recovered, mostly recovered from the loss that we saw last year, I don't know if that necessarily means that we're all clear. You know, after this huge interest rate hiking cycle, the highest, the most aggressive in history, where are we? We're left with government bond yields around 5%, yields for investment grade bonds about 6%. And those higher credit costs are great for savers, but they're I think could be problematic for people that have a lot of debt, small cap companies, a lot of American companies. I think those higher interest rates, higher interest costs are going to start weighing on the economy now going forward.
Yeah, would you say, would you say that the pace at which, because it was so fast, do you think that we've even really begun to see the results of those changes at this point in time?
No, I don't think so. I think you're exactly right, Josh. I think because the interest rate increases have happened so fast over the last 18 months, and combined with how much savings a lot of Americans had on the sidelines, I don't think we really felt the impacts of higher interest rates. And so I think that the effects are going to be a little bit delayed.
Well, and do you think that's also why I know that housing prices have come down a bit, but I don't know that we've really felt the effects. I mean, has the housing market really felt the effects of these rising interest rates? I mean, I think that you're probably sitting in this period of time where most people that, maybe before they would have, even if they still had a mortgage, if they were planning to move, right? We sell, we pay off the mortgage, we take what's left over, we roll that in, it's down payment into the next house, right? But then we get another mortgage. But most people are kind of going like, well, I don't think I want to do that right now, right? I've got a 3% or less fixed rate, and why am I going to, buy a new home and get into something that's 6.5%, 7% or more for my new mortgage?
You're exactly right, Josh. I mean, this also goes to the structure of the credit markets, right? You're completely right. For most American homeowners out there, they are locked into the house now, especially if they're locked into the rate under 3%, right? So it's hard for them to move, but they're in a pretty good position, right? They have their mortgage rate is pretty much locked in for the next 27, 30 years now, because they got that fixed rate debt. Let's contrast that completely with the commercial real estate market, the office building market. Generally, by and large, most office buildings do not have locked in 30-year mortgages on these buildings, right? A lot of these kind of owners are short-term debt holders, and so they do have revolvers and credit lines that do reset. So I think that's why the commercial real estate market is probably a lot more worrisome than the residential real estate market, just because of the nature of that debt, right? You are seeing, and I do estimate that in the next couple of years, especially the next 5 years, you will have a lot of commercial real estate buildings have to reset their rates, and they have to reset their rates at lower valuations, and it's going to be really tough.
Let's talk obstacles. What kind of obstacles do we see moving into the fourth quarter of the year? And then this way we can end on a good note and talk about opportunities when we finish up.
Obstacles are clearly with what is happening with higher interest rates and a slowing economy. With interest rates that were essentially zero a couple of years ago, and now, as I said, with the treasuries, you're pushing 4 or 5% in many cases.
Right.
How is that going to impact people and companies? And the first thing, of course, is when we talk about the American consumer. The American consumer continues to be a huge part of the economy. Right? Two-thirds, 65-70% of the economy. They've been doing really well. They continue to spend at an amazing clip over the last couple of years. they really haven't felt the impact of higher interest rates. At least they haven't shown it, right?
Sure.
And I think a lot of that's due to a strong job market. But now, a couple of things. We're seeing higher interest rates impact how much credit card and how much debt they take on. And you're also seeing a slight slowdown in the job market. Maybe people aren't changing jobs as quickly. They're not getting as big wage increases as they were maybe a year or two ago.
Right.
And so the finances are getting a little bit pinched.
Okay. So it does look like we're starting to see some signs. I mean, I've been talking about this for a while now, but the labor market's been strong for a long time. And I think that's kind of been the whole basis behind the narrative of like, oh, we're going to get a soft landing, right? Has been because the job market's been so strong. So it does seem like we're starting to soften a little bit when it comes to the job market.
Yep.
Okay.
A little bit.
And are we seeing that necessarily in unemployment numbers, or is that more in like the JOLTS side of things?
You've seen that on both sides, Josh.
Okay.
Nice cue with the chart.
Now's a good time to cue the chart? Okay. All right.
Chart!
All right. Chart. Put the chart up. Okay.
So Josh, you're exactly right. You are seeing it in two of the biggest areas that we look at for the job market, right? When you talk about the unemployment rate ticked up slightly from about 3.4%, an historically low number, to 3.8. Not a huge move, but still that trend was noticeable. And you're seeing a lot of workers come back to the job market. People that were kind of sitting out the sides of the last couple of years, you're seeing a lot of them come back to the job market, which is why I think you're seeing the unemployment rise a little bit. You're also on the other side, you're seeing the number of job openings, right? A data point we call the JOLTS, or job openings.
And so the graphic that's going to be on screen here, that's the blue line.
That's the blue line.
The blue line on top, that's the JOLTS, right? And the green line that's down on the bottom,
Is
showing
the
a slight kind of curvature up there towards the end, right? Which is now where we're getting that 3.8 is the green line.
Yeah.
Right.
So you see that slight uptick in the green in the unemployment rate, the green line, and you're seeing a noticeable decline in the job openings, which is the blue line, and that's trending low, and it has been trending low for about a year now. Okay. But it's getting to the point where I think there's a lot less employers looking for hiring for people right now, and so I think both those sides of weakness are a little bit concerning,
Yeah.
In a hot job market.
And so in the overall trend, because it really looks like it peaked in March, right? Peaked in March. The overall trend since March is coming down, even though most recently JOLTS is kind of it's tilting up a little bit there, but the overall trend is down.
Yeah.
In your mind, what would be an alarming unemployment figure? I mean, 3.8 is low, right? Because even if we get to 4.5, I mean, that's probably still actually a pretty good unemployment figure. Yeah. Am I right?
Yeah, I mean, I don't know if the job market would be extremely alarming. I think you would have to get north of 4.5%, 5% for it to be a much bigger concern for us. But it's not necessarily the absolute level of the unemployment rate of the job market, but it's the trend, right? And clearly, if the trend is getting worse, then that's more important.
Gotcha. Okay, so it's the trend. How would you say? I mean, at what point would you say that the jobs market, the figures we're seeing from there, and the trend would affect what we're hearing and seeing from the FOMC?
That's a good question. The situation with the job market and the FOMC is twofold, right? Remember, the FOMC has two mandates, right? One's inflation, and one's full employment.
Yeah.
Beneath that employment situation, and what kind of combines these two principles for them is the wage growth number, right? And the issue is that if we have full employment, are employees seeing higher and higher wage growth? Because wage growth is a really big part of inflation that gets sticky, right? It's really hard to give someone a pay raise and then take away next year, right? So once people get pay raises, they're kind of get used to it.
Yeah.
And so I think the issue with this is that they're seeing unemployment start to weaken a little bit and wage gains moderate a little bit.
Okay.
And so I think that's the big thing for the Fed, and seeing wage gains moderate so it doesn't lead to higher and higher inflation.
Okay. And just for the sake of listeners, FOMC, Federal Open Market Committee, they control what's happening with interest rates.
Exactly.
Okay. Interest rates going up slows the economy. Interest rates going down essentially helps to speed up the economy. So that's why I'm asking Ben that question. So let's see here. We're seeing less people file for unemployment.
Yeah. The job market is still quite mixed, right? You're not seeing anything that's really bad yet, but we're starting to point out noticeable changes in the trends.
Okay.
And that's when we point out the change in the trend of the unemployment rate and the job openings. it does seem like a lot of this isn't filtered through normal everyday people. And so on the other chart that we have a chart of the unemployment claims. How many people are filing for unemployment, right? If you lost your job, at some point you're going to file unemployment so you get income.
Right.
We're not seeing that. We're seeing that people that are getting laid off are finding jobs. They're finding another job to go to, so they don't need to file unemployment claims.
Okay.
I think this is part of the reason why you're seeing JOLTS decline, right? If you get laid off, you're taking one of those jobs you're taking one of the job openings, so there's less job openings as people get hired back. And so, yeah, the one thing that we haven't seen is that people aren't filing for. There's less and less people filing for unemployment benefits right now.
Okay, that makes more sense on kind of what was happening with the other chart there. We're kind of seeing unemployment and JOLTS
converging.
They're converging. Yeah, they're headed towards each other at this point. So.
Net though, I do think that your other question about the wage gains is going to be. I mean, both the charts I think really point to the fact that employees are not going to see the huge wage gains that we might have seen in the last couple of years, 2-3 years. Okay. So I think the power is slowly switching back from the employee into the employer, and I think that's probably why you're seeing some of these strikes last for so long.
So let's talk a little bit. We mentioned, you brought up inflation as being a key point. What exactly is happening with inflation right now?
There's a couple of things that we look at. There's a couple of measures of inflation we use, right? The CPI is probably the biggest one that everyone talks about. And the graphs that we put out this quarter, we used the PCE, or the Personal Consumption Expenditures Index. Mm-hmm. That's what the Fed likes to use because it gets a little bit more closer look to what consumers are spending on. But it clearly is coming down. Right, you're right. It peaked about July of last year. Mm-hmm. Really, at the same time, oil prices and gas prices were peaking, and it's been coming down since then. It's been coming down dramatically, and you're seeing nice pullbacks of these high prices, right? And you're not seeing prices go up as dramatically as we were the last couple of years. Yeah. The problem, and you're seeing that across the board. You're seeing that with the headline, what we call PCE number, which includes energy prices, fuel prices, food prices, and you're seeing the underlying core PCE number, which excludes those things. And you're seeing it on both levels. The problem is that inflation is coming down from about 6 or 7% last year down to maybe 3 or 4%, probably on its way down to 2%. But we're not seeing declines. You're seeing prices go up less slowly, but prices aren't going back to where they were pre-COVID.
Right, they're not coming down.
They're not coming down.
Yeah.
And so that's the major issue, and the issue that we're having more recently, as I think a lot of our clients and a lot of us know, gas prices are going back up. Right. And so if you notice that the inflation picture was almost like an A. It went up and then came back down. And then more recently, it's starting to spike back up a little again because of the high energy prices too.
Yeah. Considering the direction inflation has gone, the fact that economy is slowing, it looks like jobs market is maybe softening. Yep. And we potentially have this mild recession on the horizon, right? Well, does the fact that we have all these pieces, is that having an effect on the longer duration or longer end of the yield curve when we're looking at the 10s and the 30-year treasuries, we're looking far out? I mean, is the reason we're seeing this recent rise in yields due to potential for oncoming recession, or what's causing that?
Well, I think a few things are causing the interest rates to rise. And I think what we're talking about specifically is that, for most of the past 2 years, the Fed has been raising interest rates, and they raise them on the short end of the yield curve, right? Right. And when we talk about the yield curve, we're talking about from 1 month treasuries to 30-year treasuries, right? Yeah. And the Fed only affects the really short stuff, the 1 month stuff, up to maybe about 2 years. That's because of the short term stuff, and those yields have risen dramatically in the last year or so, right? As the Fed has done their thing. Yeah. The weird thing that's been happening in the last couple of years is that you really haven't noticed a huge jump up in the medium term, I would say 5 to 10 years of the curve, and the longer end, the 10 to 30 year part. And that has been, interest rates have on that side have been relatively contained. And so that's why you're seeing this huge jump up in the short end, but the long end has been pretty low. And that's why you have this what we call inverted yield curve. Right. And so and the Fed's been messaging, although the Fed has slowed and paused on their interest rate hikes this year, the Fed's messaging has been very clear. We're slowing down, but expect higher rates for longer. Mm-hmm. And at some point, it seems like in the last couple of months, that message finally got to bond investors. And they finally started selling off those longer-term bonds that I was talking about, pushing those yields higher. So, Josh, I mean, when you talk about the really dramatic rise in the longer end of the yield curve, I think there's a couple of factors, right? We talked about the messaging from the Fed is finally getting through to investors.
Right.
Expect higher interest rates for longer. Okay,
Right.
get used to
Right.
that.
Yeah.
That was the first thing that set everything off. The second thing that set everything off was really the treasuries market. And so you're seeing the government, after passing all the recent budget measures, the treasuries really come to the market and started issuing a lot of bonds.
Okay.
With how much debt there is out there in the system, especially from the government, I think there's going to be a bunch of concerns about how much debt issuance the treasury is going to have to do in the next few months, few quarters. And I think that's what the long is pricing those in. Right?
Gotcha.
What happens if the treasury has to issue a lot of short-term, long-term, intermediate-term bonds out there?
Okay. But obviously, right now the bond market, is a big topic.
Yeah. It's a third straight year. If the market closes down, the bond market this year is down about 1-2% depending on the day. If we close again this year at a negative number, this will be the third straight year of loss for the bond market. We've never had that in the history of the bond market. So this is just kind of gives you how bad bonds have been in the last 3 years, right? 3 straight years is rough.
So I mean while it's rough through the period, it kind of gives a reset and an opportunity, and right, it's come down, so now all of a sudden bonds are available. It's better price, good for savers, right? It offers safety and protection again. The 60-40 portfolio is back.
Well, you're exactly right, Josh. I mean, if you think about the 60-40 portfolio or whatever your allocation is, that bond allocation has been a really rough part of your portfolio, right? The stocks are the stocks, but that bond portfolio is probably down high low double digits for the last few years.
Right.
And that's been a huge weight on many portfolios.
Yeah.
I think the good thing, though, is that going forward, I think that's going to be a big reversal. I think over the next few years, you're going to see bonds be less of a drag on portfolios and be a much bigger contributor. And I do think the bond market probably is going to average 5 to 7% for the next few years.
Because then it can give us more consistent income, right? And B, when there is a flight to safety, it makes more sense to move into bonds, which can be helpful again in the future.
Completely.
Right? Okay.
Yep.
A few years ago, it was all about FANG, right? What's going on right now? I mean, we have like the Magnificent Seven.
After the rough year we saw last year in the stock market, I think there was a lot of concerns about how strong the economy was going into this year. And so I think it was really surprising when a lot of technology stocks really started leading the way in January this year. And I think it was really led by the first big trend of the year was the AI trend, right? And when ChatGPT came out, it took the world by storm, and that really led to a huge boost in some semiconductor companies, some technology-facing companies that really leveraged the AI business, and they just took off and they kind of led the way and haven't looked back. And that trend has also pulled in some other technology companies that now are pivoting to the AI market and pull them along too. And so you're really having about 7-10 names that are really leading the market this year.
Yeah.
And
this is coming off of last year when tech was completely out of favor.
Exactly.
Right? Tech got hit the hardest.
You're seeing some of the companies that did really bad last year are some of the best performers this year.
Right.
And so that's really led to what we call low breadth, or really small concentration in the market, right? And so when we say low breadth, that means that the market or the S&P's performance is really dominated by just a handful of names, and that means that the gains are not really widespread, and that's not really healthy, right? Especially it's kind of like a sports team. You don't want one player dominating and doing everything for the team. You want the whole team to be doing well.
Right.
You're not seeing that this year with the S&P 500. You're just seeing a really tight concentration.
Do you happen to know, and it's okay if you don't know exact figures, it's kind of just throwing this question out there, but if you were to remove those top 7 to 10 names, how's the rest of the market? I mean, is it still on a positive trend for the year?
It's still on a positive trend for the year. Well, just to put some statistics to it, these top names that we're talking about is responsible for about 90-95% of the returns this year, right? And the S&P is up, depending on when you watch, it's up in the teens, right? 13 to 15% this year. So they're contributing to a massive share. When you look at an index without those biggest names, you're probably up maybe 2 to 5% this year.
Okay.
And so that's the delta.
Yeah.
You know,
It's a big difference.
That's a big difference. And if you look at it, you can see what's the Dow doing. The S&P is up as of the end of the third quarter. The S&P is about 13%, and the Dow 30, right? The Dow only has 30 names. Is up less than 3%.
Right.
So that kind of gives you a good contrast to what the rest of the market is doing outside those 5-10 names that we're talking about.
Right. Okay. And we're really just kind of comparing the Dow and the S&P.
Yeah.
Right.
Just as for illustration purposes.
Okay. So I think this gives us a really good kind of summary of what's happening economically. What are you and your team doing in response to all the information and things that we talked about right now?
Yeah. So, our base case here is that things are slowing down, right? I think on the super short term level, especially for Q3, which we just finished, I think you're probably going to see a nice pop in GDP this past quarter.
Okay.
We'll start to get that data soon. But other than that, I think things are trending lower, given that we talked about the higher credit costs, slowing consumers, slowing job market, and higher interest costs for everyone. I think things are slowing down. When I see those characteristics, Josh, that really it really reminds me that I think we're going to the later stages of this business cycle, right? And how the business cycle goes, and higher credit costs, tightening credit. It just means that I think things are going to slow down. The economy is just entering a little bit slower phase. So how do we invest in that kind of time frame, right? And for one thing, we keep on talking about bonds.
Right. Yeah.
Bonds. I think bonds are an extremely attractive opportunity as the Fed's probably done raising interest rates,
right.
and with inflation slowing. Investors are able to get a really high real rate of return. And when I mean real rate of return, I mean after inflation.
Right.
On the equity side of portfolios.
Well, before we jump into the equity side, I do want to note, if you want to talk just briefly about it, you talk about bonds. Your team's actually made quite a bit of changes on the bond side of the portfolio recently. Mm-hmm. And I know we can't name specific names because everybody's different, but overall from general theme, do you want to kind of talk about what those swaps were all about? The names that shifted around in client portfolios on the bond side?
That's a great point. And so, we started worrying about inflation a little bit early. Right? And one of our first trades into this was in about September of 2020, right? Really in the heat of COVID, where we started taking this bond portfolio that we have and started moving the mixture around and going what we call a super short and super high quality. Right. And that meant super short-term bonds, super high-quality bonds, government bonds, investment-grade bonds, single A, double A rated. I think that has allowed the bond side of the portfolio to really outperform in the last couple of years.
Right.
Staying short, staying high quality. And so with inflation, with the Fed raising interest rates, those bonds should do a lot better than longer-term bonds, junkier bonds out there.
Which anybody that has been doing reviews, for the most part, I think everybody has pretty much experienced that. If you're looking at that fixed income side of the portfolio, that really the fixed income has been outperforming what's been happening in the broad markets.
Exactly. Now, what we think that the Fed has probably done, we started in the past few months shifting out of that short, super high quality, super short term side of the bond, and then moving a little bit longer term bonds and a little bit more investment grade quality bonds.
Okay.
So we've added a couple bond funds to the mix. We've got rid of some of our mortgage related bonds and got a more diversified bond portfolios with a higher yield, and you're starting to see that. I think they're going to be just nice results.
Okay, and so if I'm tracking, the thought process behind that is we don't need as much short duration anymore because we don't expect interest rates to keep rising the way they were before. And now that we're kind of reaching that peak, we can take a little bit longer duration bonds because we can get more yield.
Lock it in.
And lock it in for a longer period of time.
Exactly.
Right?
Yeah.
Okay. All right. Great.
Yeah.
And then while we don't know what's going to happen with interest rates, but at a certain point in time, if interest rates come down, those should benefit more than what the shorter duration bonds would have.
Exactly.
Okay.
Exactly. But even if interest rates don't get cut, and I don't know when they're going to get cut, at least we're clipping a coupon now at 4.5%, 5.5%. Right? And so we're just collecting the income, which is a lot, which is 3 times higher than it was a couple years ago.
Okay. Beautiful. Okay, thank you. I didn't mean to cut you off. You were going to talk about the equity side as well.
Yeah, on the equity side, I think it's a little more challenged. Okay,
Sure.
I think there's a lot more opportunities on the bond side because of what's been happening with everything we just talked about with higher interest rates. On the equity side, I think it's going to be a lot more challenging, especially as the economy slows down and as we do enter this new phase of the cycle. Right? And so this year, a lot of technology companies did really well, but now they're extremely expensive. And as things start to slow down, I think you really need to pay attention to valuations. Sure. You need to pay to individual companies and how they're getting affected.
Yeah.
And I think it's really important to really know what you own.
Right.
You know.
Yeah.
And for us, we continue. I think the important thing, especially as we go to this stage here, is know what you own. What kind of businesses do you have in the portfolio? And for us, we really want businesses that they're doing something different, right? They have some unique product. They have some unique niche. They have really a strong competitive advantage, right? And
sure.
And I want them to have that competitive edge, so they just can't lose market share to another provider, right? You don't want just another plug and play operator. And so we want somebody to have a distinct advantage, and they're going to make money off that.
Right. Any other last thoughts as we move into to fourth quarter here?
I think this is a extremely challenging market. Right?
Yeah.
It's a really challenging economy. Probably some of the toughest I've seen in the last 25 years. It's not just the fundamentals of the economy, but we are at a heightened geopolitical risk right now, right?
Yeah.
With everything that's going on around the world, everything that's going on in DC here at home too, and it's really challenging. And so I do want to find investments, great businesses, equity in businesses or debt in businesses that can make it through some of these rough times. I do think things are slowing down, but I don't have a crystal ball.
Sure.
I think this can go either way in many cases. But we want to find good management, good companies, good products that can make it through the good times and the bad times.
Yeah.